A good jobs report just came out. Interest rates are expected to come down throughout the remainder of the year, and we could be getting tax cuts. Plenty of reasons to be optimistic about further growth, but there's still plenty of reasons to be concerned. We still have tariffs, and what is the story going to be there? We still have a lot of negotiations that could impact future earnings. So although I'm still optimistic throughout the remainder of the year, we do want to be cautious. So in reality, we are looking for the stock market to continue to march higher, but it doesn't mean we won't have bumps in the road. And as such, in today's video, I'm going to be focusing on the rest of the year, where we'll be talking about 7 stocks I expect to outperform throughout the remainder of the year. So make sure you stay tuned throughout the entirety of this video so that you see all 7 stock picks that we're talking about here today. And if you could do me a huge favor, show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump into our list of 7 stocks I expect to outperform for the remainder of 2025, and let's get right into it with stock number 1, which is going to be Amazon, stock ticker AMZN. And when it comes to Amazon, this is a position I do already own and one I'm looking to grow. And there's a lot of reasons to be optimistic about Amazon moving forward. They have their hands in a lot of different areas, whether it's cloud, advertising, e-commerce, subscriptions, the list goes on. The company currently has a market cap of $2.2 trillion. Over the past 12 months, shares have climbed 18%, but year to date, still down 3%. Amazon has their hand in many different areas, and I love investing in diversified businesses. Why? Because when one area of the business may not be performing all that well, there's other areas that can pick it up. The company has seen their revenues continue to expand from $386 billion back in 2020 to over $650 billion over the trailing 12 months. Operating income was $22.9 billion in 2020. Over the trailing 12 months, that has now reached a new record of $71.7 billion. EBITDA is at a new record high as well, with a 5-year CAGR of 35%, which is very intriguing as an investor. So when it comes to top-line revenue, things continue to move in the right direction. Maybe not at the pace that they once were, but that's going to be accustomed to any company that grows to the size of Amazon. Now, from a valuation perspective, shares are still intriguing, but not as intriguing as they were back around the $180 level when I was pounding the table to all of my Discord members. But when it comes to valuation, shares trade at a forward PE multiple of 33.5. This, looking back 5 years ago, the PE was at 78. From an EV to EBITDA perspective, shares trade at 17.2, well below the company's 5-year average of 24.3, and this happens to be the lowest EV to EBITDA ever in the history of the company. We are talking about this is the cheapest from an EBITDA perspective that you can buy shares of Amazon. Analysts currently rate the stock a strong buy with an average 12-month price target of $242 per share, giving you upside potential of nearly 13%. And that leads us to stock number 2, which is going to be Alphabet, stock ticker GOOGL. Alphabet is another name I'm very excited about. They have huge advances in AI, and they're already a dominant player in advertising. Oh, and by the way, they're the cheapest of all Mag 7 stocks. The company currently has a market cap of $2 trillion. Over the past 12 months, shares are down 4%, and year to date, still down 9%. Alphabet is another name like Amazon that has a lot of irons in the fire. As I mentioned, they're already dominant when it comes to advertising. They have the 2 largest search engines in the world with Google and YouTube. They have driverless technology with Waymo, which is far in advance that of Tesla's robotaxis. And then you bring into the equation AI with Gemini. They're making huge headwinds. And I can't forget their cloud business. Outside of a few market ETFs, Alphabet is my largest single individual stock. a position that Amazon will one day hold. But if you're interested in seeing my entire portfolio, get trade alerts for stocks I'm buying or selling, deep dives, and also partake in my monthly members-only meeting, then make sure you become a subscriber to my newsletter, The Stock Investor's Edge. Check out the link down in the description below. Getting back to Alphabet, in terms of revenues, again, another company with growing revenues as they have a 5-year CAGR of 18.5%. The company is also finding ways to be more efficient, with operating income increasing from $41.2 billion in 2020 to $119.3 billion over the trailing 12 months and a CAGR of more than 20%. Even with the company spending close to $60 billion on CapEx, free cash flow continues to grow at a record nearing $75 billion. Looking now at valuation, shares trade at just 17.5 times forward PE, well below the company's 5-year average of 22.2 times. EV to EBITDA, also extremely cheap at 13.6 times, again, well below their 5-year average of 17.1. Only 2022 did the company have a lower EV to EBITDA multiple, and if you look back, you probably wish you bought more at that time. Analysts rate the stock a strong buy with an average 12-month price target of $200, giving them 15% upside from current levels. And that leads us to stock number 3, which is going to be Uber Technologies, stock ticker Uber. This is another name that I was pounding the table on in early spring in my Discord community when shares dropped to the low 70s and even below $70 per share. I put a trade alert out in early March with the stock trading around $70, and I still like the name here in the low 80s. Uber continues to find its way higher, even in the midst of Tesla robotaxis, even in the midst of Alphabet or Google's Waymo. There's room for all of these types of companies, and Uber is going to be a major player. After all, it's like Alphabet, or Google, I should say. It's a verb. You Google things. You Uber to destinations. The company currently has a market cap of $177 billion. Over the past 12 months, shares are up 28%, but year-to-date, up over 40%, making it one of the best performing stocks in the S&P 500 so far this year. Ever since Dara Khosrowshahi took over as CEO of Uber back in summer of 2017, the company has seen some impressive gains. Free cash flow for the business was negative at the time. Today, the company is generating nearly $8 billion. In spring of 2019, the company became public at a price of $42. However, in October of 2020, the company did a 4-to-1 stock split. So really, when you adjust their initial IPO price, they really IPO'd at just $10.50. Today, when you look at where their stock price is today, the stock has nearly went up over 7x. When looking at revenues, they continue to expand at a strong clip, 35% over the past 5 years, rising to nearly $44 billion in the past year. Operating income flipped from negative to positive in 2023, and in the past 12 months, the company generated operating income of nearly $4 billion. Free cash flow was negative just 2 years ago, but in the past year, Uber has generated nearly $7 billion in free cash flow. Now for valuation, where multiples will appear higher due in large part to the company providing and relying much more heavily on growth, the stage of the business on where they're at. The forward PE currently sits at 29.8 times. Analysts are expecting 20% earnings growth over each of the next 2 years. In terms of EV to EBITDA, that sits at 27.6 times. Price to sales is at 4.0. Analysts rate the stock a strong buy with a 12-month price target of $99, giving you 15% upside from current levels. Stock number 4 is going to be Salesforce, stock ticker CRM. And when it comes to Salesforce, this is a software play, and yet another way to play AI, as businesses look for ways to implement AI software in order to save money and become more efficient. The company currently has a market cap of $255 billion. Over the past 12 months, shares are up 13%. Year-to-date, though, down nearly 20%, and the worst performing year-to-date stock on the list. So I've talked about this before. When it comes to AI, it happens in phases. The first phase is really centered around building out the infrastructure, data centers, and the chips. The second phase to me, and although we're a little bit early to it right now, but we're starting to see it more and more, is the software phase. How can companies start implementing a lot of what's been done with AI to start saving and becoming more efficient with their business model. There's huge opportunity here for Salesforce. They are a leader in the software space, but competition is fierce. When it comes to revenues, although they're not growing at the same pace of years past, they are still growing. And in 2024, the company generated top-line revenue of nearly $38 billion. Operating income over the past 5 years has grown from $455 million to $7.7 billion in 2024. EBITDA is at a new record high of $11.1 billion with a 5-year CAGR of 40%, which again is very intriguing as an investor. So from a sales perspective, things have slowed. The growth rate isn't as fast as it once was, but that's okay from an investor standpoint, as long as businesses find ways to become more efficient. Now looking at valuation, where shares trade at a forward PE multiple of 23.7 times, well below the company's 5-year average of 35.2 times. EV to EBITDA sits at 23.8 times, again well below their 5-year average of 34.7 times, and the lowest EV to EBITDA ever in the history of the company. We're looking at something identical to that of Amazon. Analysts rate the stock a moderate buy with a 12-month price target of $348, giving the stock 27% upside from current levels. And that leads us to stock number 5, which is going to be Palo Alto Networks, stock ticker PANW. Heading into 2025, I really had 2 major themes, one being around AI and the other cybersecurity. And if you think about it, if we head into a slower economic period, there are things that companies need to pull back spending on. AI is one of them. Businesses cannot afford to pull back on their spending centered around cybersecurity. Data security is of the utmost importance these days for businesses. When it comes to Palo Alto, they are one of the largest cybersecurity players with a market cap of $131 billion. And over the past 12 months, shares are up 35%. Year to date, up 10%. Palo Alto is a stock that, for much of the past year, has been range-driven, trading between $175 and $200 per share. And the stock is gearing up to potentially take that next step. Across the board, cybersecurity stocks are all up. You could look at ETFs like CIBR or HACK, all of them having great years thus far. When it comes to Palo Alto, revenues continue to grow from $3.4 billion in 2020 to $8.9 billion over the trailing 12 months. Operating income hit a new record high of $1 billion nearly over the trailing 12 months, a figure that was negative back in just 2022. EBITDA also hit a new record high of $1.25 billion over the trailing 12 months. So I like where this company is going, and the future is bright. Now let's take a look at valuation, where shares traded a forward PE multiple of 53.9 times, pretty much in line with their 5-year average of 53.1. EV to EBITDA still high at 98 times, which although is half of their 5-year average of 183 times. And then one other angle, price to sales. Shares trade at 15.7, above their 5-year average of 10.6. So of all of the stocks on our list, although I'm excited about cybersecurity moving forward, this is probably the one from a valuation perspective that I'm not all that excited on investing in right now. So this is going to be a high watch list stock. I'm looking to add to this on any major pullbacks. When it comes to analysts, they tend to agree, as they rate the stock a moderate buy with an average 12-month price target of $214 per share, giving the stock only 7% upside from current levels. And that leads us to stock number 6, which is going to be PayPal Holdings, stock ticker PYPL. And of all of the names on our list so far and the other name to come, this is the most volatile name. This is the one that also comes with the most risk. But I also believe there's a ton of upside when it comes to PayPal. The company currently has a market cap of $70 billion. Over the past 12 months, shares are up 14%. However, year to date, they're down 14%. And again, there's a lot of reasons to be optimistic about PayPal moving forward, especially under the leadership of their CEO, Alex Chriss, who's only been in the position for roughly a year. Some of the reasons that I'm optimistic when it comes to PayPal is due in large part to we are moving more and more towards a cashless society. We are continuing to see growth and higher penetration in e-commerce, and I really am looking for the company to get more out of Venmo. Here's a look at the company's growth drivers, which include a lot of what I just talked about moving forward as they presented at their Q1 earnings call. Revenues for the company continue to expand from $21.4 billion in 2020 to $31.8 billion in 2024. Operating income was $3.4 billion in 2020, and in 2024 it has now reached a new record of $5.6 billion. EBITDA has also set a new record of $6.2 billion with a 5-year CAGR of 14%. The CEO is still going through implementing new changes to PayPal, driving innovation once again, which both analysts and investors alike are looking for. Now turning our attention to valuation, where forward PE trades at just 14.2 times, well below the company's 5-year average of 19.3 times. EV to EBITDA sits at just 10.9 times with a 5-year average of 17.4. Again, the lowest EV to EBITDA ever in the history of the company. And price to sales sits at 2.3, again, well below the 3.8 multiple they've had over the past 5 years. Again, the valuation isn't all that expensive. They're not getting a lot of credit, which is one big reason I really like shares of PayPal. When it comes to analysts, they rate the stock a moderate buy, with a 12-month price target of $81 per share and just 10% upside. However, that is skewed heavily by one analyst, with a $49 price target, and from the looks of it, this analyst's calls on this particular stock have not been all that good. So if you pull that target out, the average for PayPal jumps quite a bit. And in full disclosure, PayPal is a position I recently added to my portfolio by way of options. And again, if you're interested in seeing my entire portfolio or seeing my option plays, then become a subscriber to my newsletter, The Stock Investor's Edge. That link is down in the description below. And that's going to bring us to stock number 7, which is going to be Taiwan Semi, stock ticker TSM. And when it comes to AI, this is the juggernaut of all AI. Pretty much everything seems like it runs through Taiwan Semi. Again, they are a chip manufacturer, a foundry company, building the chips for the likes of NVIDIA, for Apple, for Broadcom, for Qualcomm, and the list goes on. The company has a market cap of $1.1 trillion, making it one of the largest companies in the U.S. markets. Over the past 12 months, shares are up 27%. Year to date, though, only up 4%. Taiwan Semi is yet another great way to play the AI space. Because again, you don't have to pick the winners between the chip companies. Is NVIDIA going to outduel AMD? Is Intel going to make a comeback? Broadcom, Qualcomm, whatever the case may be, because Taiwan Semi wins when all of those companies are doing well. Now, there are risks that do lurk when it comes to Taiwan Semi. One of them is a pullback in spending when it comes to AI. The other is their location, and China's looking to potentially overtake Taiwan. However, the company is expanding facilities into the U.S., where back in 2020, Taiwan Semi chose Arizona to build its semiconductor manufacturing site, initially investing $12 billion, but now that figure is up to $165 billion. Revenues for the company continue to expand from $47.6 billion in 2020 to over $105 billion over the trailing 12 months. Operating income was just $20.2 billion in 2020, and over the trailing 12 months, it has now reached a new record high of $49.4 billion, with operating margins at 47.2%. EBITDA also at a new record high of nearly $72 billion, with a 5-year CAGR of 35%, which is very encouraging to an investor. Shares have had a nice run of late. They were trading in the 170 range, but now sitting back above 200, they're not as intriguing from a valuation perspective. And let's have a look at valuation right now, where shares trade at a forward PE multiple of 21.7, slightly below their 5-year average of 22.5. EV to EBITDA sits at 12.2, slightly above the company's 5-year average of 11.7. So when looking at both of those multiples right there, we get the conclusion that maybe the stock is closer to fairly valued. However, this is a company that has evolved immensely over the past 5 years. And when we see the kind of growth that we've seen from Taiwan Semi, from other companies, what do we usually see from a valuation perspective? Expansion. Expansion in the multiples. A PE of this that has now expanded higher because of the faster growth, the higher efficiency, and things like that. That's what I believe is going on when it comes to Taiwan Semi. Now looking at analysts, where they rate the stock a strong buy with an average 12-month price target of $223 per share, but that only implies 9% upside. However, there is a high price target of $251 per share. So there we just looked at 7 companies that I believe have a high likelihood of outperforming over the rest of this year. I invest in all of these companies, and I'm looking to invest more in these companies moving forward. So in the comments section down below, let me know which of these 7 stocks do you already own and are you looking to buy more of moving forward. And if you haven't done so, I'd really appreciate it if you click that video down below, share this video with someone else, and subscribe to the channel. Thanks again, and we'll see you in the next one. Take care.